Welcome back to Coffee with your coaching consultant, talking about your finances and how we can empower you to know that you can be on top of them and make great decisions. Last time we introduced the idea of why do people struggle with it. There are many good reasons. And when people come in, there are some really basic questions that they have that they know if they just understood. How much should I pay myself? Where's my cash going? How do I know if my business is solid and sustainable? And a lot of it does come back to cash flow. So we want to have Jim dive into that this time and talk about that question. As people's businesses grow, there is another cliche that is not a myth. Growth consumes capital.
Absolutely. I'm Jim Plow. I'm your consultant.
And I'm Cher Cunningham. I'm your coach.
So you've heard the expression cash is king, and that is absolutely true in all businesses. And it is growth can kill your business, not because you're not successful, obviously, but because it can eat all your cash. And if you're not prepared for that, and there are a bunch of different ways of being prepared for that, one of them is having a business plan. If you're prepared for the cash demand that your growth is going to cause or result in, then, it's just an important thing to be aware of. So cash is king. And what we're going to do today is discuss how profit and cash are different, because it is a very, very common misunderstanding, I guess. We've been talking about myths, misunderstandings, and malaise in business finance, which is where we have an event coming up on June 27th. We would love for you to join us at our location 4. And we're diving into a bunch of different topics there. Cash is a big one.
Yeah, and what's interesting to me is growing your business does consume capital. But what's interesting, even before we get to that point, is if you're not profitable, selling more of something that's not actually profitable will also eat your capital. So healthy growth, healthy, solid, yes, you're doing this right growth also still consumes capital. You're doing everything right, and your cash still seems to disappear. So they're the two very different topics.
Yeah, we in our program, our TradeWinds program, the focus is always on getting the finances of the business right, in the right business model before you grow, because you can grow a small problem into a large problem just by driving growth, because your price isn't right, or your gross margins aren't right, or your labor markup's not right, or so many other reasons. So that is a different topic, but it certainly can impact your cash in a very negative way, not just because you're growing, but because you're growing at the wrong profitability.
So if you could start, maybe give us an example of how does it happen that as you grow your company, your bank account dwindles, the revenue's coming in, but the cash isn't there?
Okay. I'm going to draw a little example here of some components of cash flow that maybe you're not familiar with. So let's just start with a revenue number. Looking for my black marker. I have my black marker. So let's say your revenue is $2 million. And let's say your profit is running 10% of that, so you have $200,000 in profit. And then we're going to, if you watched our first introductory episode, I'm going to take the tax off because you have to pay tax on your taxable profit. So we're going to round numbers, assume that you pay $20,000 in tax, and you're left with $180,000. That number is the starting point of what happened to your cash for the period that you're looking at. It's not, that's where the sort of confusion comes in. So like I made $180,000 after tax, and my bank account actually went down, or I only have $30,000 left. So where did that go? So the first thing that you need to do, and this is your starting point, this is your after-tax profit. So to that, you're going to make an adjustment called a working capital adjustment. So what's working capital? If you take a look at your balance sheet, working capital is the difference between your short-term assets, which are always made up of cash, accounts receivable, and inventory, if you have inventory. So those are your short-term assets. And then your short-term liabilities are, your payroll remittances and HST that you owe and your accounts payable. And if you actually have debt in your business and some of that debt is due in the next 12 months, that'll actually be in that amount as well. So it's the assets that are going to be realized have a less than 12-month shelf life, like a receivable is not going to be out there for more than 12 months. So it's your short-term assets minus your short-term liabilities. That's what working capital is. So let's say...
I've never heard that definition myself before.
Okay.
So
everybody learns.
If that's your working capital, is it the right number, or do you actually have to look at that number and go, I actually need more in the bank as working capital available? Is it usually right on your balance sheet, or do you actually need to think about that number?
So the amount of, so first of all, the number should be positive. So if you have negative working capital, which means your short-term liabilities are larger than your short-term assets, you're in a cash crunch. So that's a thing you should know. The working capital amount, there is sort of right amounts, and it's ratio driven. And it depends what industry you're in, how fast you're growing. So A, a positive number, more short-term assets than short-term liabilities, and B, it should be a ratio. And if you go get financing from a bank, they're going to look at your working capital as their number one source of determining whether or not you can meet the obligation of repaying the loan. And the interest on the loan is your working capital. We talked about gross margin being how efficiently you deliver your services to your clients and make money. The working capital is the effectiveness and efficiency with which you manage your cash flow. Like, it's the number one measure.
So what if I'm not very good at collecting on my receivables, but I'm really good at paying what is due to my vendors? Does that have an impact on that?
So that is a really good question, and it's a very common thing, as you know, when we have clients come in. Our clients, by and large, are extremely community-oriented, are sensitive to the needs of other small business owners because they're small business owners. Mm-hmm. And it is often the case that they're paying, you are paying your accounts payable too quickly. So a bit of a rule of thumb here. You want to try to collect your receivables in 30 days and pay your payables in 45. In other words, you have your suppliers helping out your working capital. And I know that equation can't work for everybody, right? Those numbers have to be the same across all industries. You can't just extend 45 days one way and 30 the other day, and that leaves a disconnect. But in general, you want your accounts payable to at least be not being paid more quickly than you're collecting your accounts receivable. So that's a bit of a rule, and 45 days is a good rule of thumb, especially if it's a large supplier. That is particularly problematic in service businesses because you don't get to not pay your employees for 45 days.
Right.
So the cash flow requirements of a service business, especially one that's not effectively collecting the receivables, can be really, really, really problematic.
So operating capital and cash flow requirements are two different numbers. Operating capital is what do you have?
Working capital.
Working yes. Capital is what you have, and cash flow requirement is what you need.
Right, so cash flow is over time. working capital's a snapshot. So working capital says, this is my short-term money I got to work with. And cash flow is, what does that look like over time? And working capital is just one component. I'll lay out some of the other pieces here, but I'm going to call, so let's say you're, and to Cher's point, sometimes you land a large client and they're a large company and they're not going to pay you inside of 45 days. That's how large businesses work. In fact, they may not even pay you inside of 60 days. In fact, you may miss a billing cycle and not get paid for 90 days. That's one full quarter. And in the meantime, you're still paying your employees. So now you've got a serious, you landed this large client, you're so excited, and just the accounts receivable aspect of that it can be crippling.
It's one of the reasons I guess you need that to figure out how big the deposit needs to be if you've got a person who's paying slow, if you can get a deposit.
Right. Yes, absolutely. So deposits and retainers and all that form part of managing your cash flow. So let's say your accounts receivable have gone up by $250,000 because you landed a large client, and your accounts payable went up by $50,000. Right? So this is money that is added to your business because you didn't have to pay it, because your suppliers have essentially lent you $50,000. You lent $250,000 to your customers. So the net of that is that you're out of pocket $200,000, because that $250,000 is already in that number and it's in that number. So you may have sold that client $250,000 of your $2 million, and that's in this profit, but you have not got the cash yet. So you're thinking 180 is in the bank. That's not in the bank yet, although it's accounted for in these numbers. So already your cash has decreased by $20,000, even though you think you made $180,000.
Wow. So this is when you get that big account, you land it, and you're like, I'm taking a dividend. I'm going to celebrate that I had a $100,000 day. You need to wait till everything settles out before you make that move, because that would bottom you out even further if you're thinking that's a nice big chunk of what's just happened.
Absolutely. And negotiating payment terms with large new customers especially, super important to understand what they're going to do, because if they tell you no, we're not going to pay for 60 days, you probably need to be going to talk to your bank about the fact that you will need a loan.
And this really reinforces for me even deeper, landing a whale of a client is not the way out of the doldrums. If you're feeling trapped in your business and you're like, I just need a big client, now that client starts to own you and is tying up your people and not paying you. And so that whale of a client in general is also a challenge, because if you have a client who is 30 or 40% of your business, you're kind of held
economic
for ransom.
Dependency. Yeah, absolutely. Absolutely.
And if you're employing service people to serve that client and you lose them, that's again that huge chunk of added expense that you aren't needing, can't justify without that big client. So that rule of don't have a client bigger than 15% of your revenue, this is all part of that.
It's all part of the cash flow. So a couple of other things that come into cash flow that are unrelated to the profit. Now, this stuff is related to your profit and loss statement, right? Your accounts payable were part of your expenses in delivering the service. So this is all tied into your profit and loss. But there are things in the cash flow statement that are not related to your profit and loss, so directly. So here's one of them. Let's say, so we're going to call this capital expenditures. Let's say I spent $40,000 on a new piece of software to run my business. That has nothing to do with your profit and loss statement. It's just a check that you wrote out of your bank. The asset that you bought, the software that you bought, you don't get to expense that in the year you buy it. That's not how the government lets you do that. They want you to invest, but you don't get to write it off in the year you buy it. So it's sitting on your balance sheet. It's completely bypassed your profit and loss statement. But hey, I bought a piece of software, and that's another $40,000. Brackets means negative, of course. $40,000 out of my bank account. And then, because you were thinking that you were going to grow, you went and got a line of credit from BDC. And the line of credit from BDC, you're paying it back over 5 years. You borrowed $100,000, so you owe BDC $20,000 of principal repayment on the loan. So you're repaying your debt. That's not going through your profit and loss statement either. So, or let's say you're repaying it over 4 years. You have $25,000 worth of debt repayment. That's not going through your profit and loss statement. So now you are $85,000 less cash than when you started, and you were thinking that you had made $180,000.
Wow, that clears a lot up, adds a lot more questions. I know one of the questions we look at with people when they come in the doldrums is, what size of business do you, what are your goals with your business? And often their goals are that I need to make 10 million off it, but another goal is I want to be a $3 million business. You're, for various reasons, about to put yourself through some interesting challenges that, as long as you know they're coming, awesome, you can deal with it, right?
Oh,
this is not a problem. This is good, as long as you knew it was coming.
If you're running a profitable business and you're projecting that you will need cash, and you have the gross margins to support the debt in terms of there's going to be an interest charge, as long as you can prove that, many financial institutions will lend you the money to allow you to grow. If you don't see it coming, that's a problem. If you show up at the bank not understanding your cash flow without a business plan, that's not a good place either.
Which is that funny other myth that if you need money, that's when you can't get it.
Right.
It's true, but if you need money for the future and you've got a plan, then you can get it. So when you show up down here,
yes,
that the bank goes, you don't have the management skills that we think you should get a loan.
Absolutely. I would say that business owners that do look at their financial statements are probably mostly looking at their profit and loss statement. And you should, as the CEO, and your focus should be on gross margins. That's a discussion that's going to come a little later in the series. The cash flow statement is at least as important as the gross margins, and it's a thing you should be focused on all the time as a small business owner. And generally, people don't.
Well, that was an education for me. I hope it was an education for you as well. When we have our event on June 27th or in advance, get a North Star session if you know this is a challenge. A beautiful program that is a good deep look at your finances and what a CFO or a controller or both would see when they're looking at your finances. So we will come back next time and talk about, you really deserve a team supporting you in your business when some of these things are what are ahead of you. And what does that team look like?
Looking forward to it. I'm Jim Pillow, I'm the consultant.
And I'm Cher Cunningham, I'm your coach.